Good evening. I hope you're doing well. First of all, thank you very much for liking, subscribing, and commenting on the channel. In one of the comments, a trader has asked the question that how can we apply that which we have learned during our study of technical analysis in day-to-day market price action. And in my view, that is an interesting question because a lot of people formally and informally study a lot of aspects of technical analysis, but when it comes to applying it on a single chart, they often struggle. The idea of sharing the perspective of my perspective in this video is to help you collate some of those points and to see what we have to apply. The first thing when we look at a chart is to make a clear assessment that we do not have to apply everything that we know in the subject of technical analysis. The framework of evaluating a chart is to first clearly outline the trend which forms the dominant bias. And for the purpose of the video and all videos that I have covered in this channel, I have always used the weekly time frame as the trend determining time frame. This is done so that I don't have to keep analyzing the trend repeatedly as I make presentations on YouTube for you. So on the weekly time frame, there is no ambiguity that the index is in a structural bull trend. And the reason for that is this pivotal high that we see that was formed on the 9th and 10th of April is actually the market's all-time high. And it is obvious that when a security creates an all-time high, it is only possible when fresh money is added into the market. And fresh money can only be added into a bullish market. So by theory, there is no ambiguity that the trend of a security is up when there is a new life high. But once that assessment has been made, then we shift our attention to the daily time frames or the shorter time frames in order to make tactical level decisions. And one of the best tools for making tactical decisions are candlesticks and gaps. Many traders have also asked the question, what are some good books to study? In my view, Steve Neeson's book on candlesticks is perhaps one of the best books on candlesticks to study. He covers almost all patterns that are relevant and also uses discretion to interpret them and applies them and gives several examples. And this video hopes to be one such example. So for example, let's have a look at the candle that is formed on the 9th of April. This candle gapped up significantly and closed. But if we notice that the close of this candle at 22,642, which will be visible here at 22,642, is pretty close to the candle a day before that on the 8th of April at 22,666. Now, once there is a gap up opening followed up by a close on the previous day's close, then by theory, such a candle forms what is known as a bullish counterattack. So since it's a red candle formed at a high, this will be a bearish counterattack. And this was formed on the 9th of April. The reason why I'm mentioning these dates is so that when you analyze on your own, you train your eyes to identify these patterns. After this a large body bearish gap up candle was formed. Near the high, we see a very small body candle that is formed, which is completely included in such a body. That is, the candlestick formed on the 10th of April trades almost exclusively within the range of the 9th and also has a very small body compared to the previous day candle. Therefore, such a candle becomes a bearish harami. Now the interesting thing of a bearish harami is even though it is a bearish candle, it does not have to be necessarily a red close. So even green closing candles can be bearish haramis. Now, like any bearish candles, we need a confirmation, and the confirmation would be a close below the low of the candle in which it is formed. Here we can see that the low is formed on 22,615 and the candle that was formed on the 12th of April decisively closed below these lows, thereby confirming the occurrence of a bearish harami and a bearish counterattack candle. Once this low was created, we can see a gap that was formed. Now when a gap is formed, it is an indication of high sensitivity or a very high VIX. Basically the market starts panicking. The panic could either be on the sell side or on the buy side, but whenever a gap is formed, we always have to see if it is a breakout gap, and if it is a breakout gap, it is almost always followed by what is known as a measuring gap. So here we can see that the breakout gap was followed up by a measuring gap, and therefore the gap targets were also completed. Subsequently, we can see a very small candle that is formed on the 16th of April after a gap, and after this candle was formed, we can see the opposite of an inside day or a bearish harami. We are now seeing an outside day candle. So a bearish harami candle is also called as an inside day. It is a reversal candle. I hope this is visible. And this candle that is formed on the 18th of April becomes an outside day candle. And why is it an outside day? Because we can clearly see that the trading range of this candle entirely engulfs the trading range of the previous candle and does so very, very comfortably. This obviously outside day near a potential pivotal low, the pivotal low that I am referring to is right here. Somewhere around here. The occurrence of an outside day very close to a pivotal low signals a possibility of a bullish reversal, but we have no confirmation and we are waiting for more patterns to form. And on the subsequent day, that is on the 19th of April, we can clearly see a bullish piercing candle. Alright, why is it a bullish piercing candle? Because we can see that after the gap down, the market closed more than 50% of the previous day's body. Had it been more than 100%, this would have become a bullish engulfing candle. And what does a bullish piercing candle mean? It obviously means a confirmation. And what is a confirmation? A clear green closing above the high of the candle. Now, after the occurrence of this bullish piercing candle, the subsequent day, that is on the 22nd, we do not have a clear green closing. Rather, we have a question mark which is in the form of a doji. So which means that on the 22nd of April, market asked a question, are you up or down? So it is an indicative of an market which is not sure of the direction in which it has to generally proceed. The market progresses upwards, and today we see a gap up, open high setting with the resistance taken at the previous gap. So now we can see here that this is the gap resistance that is in play, and we also know that in this gap resistance a clear green closing will confirm the bullish piercing, whereas a red closing will retain the market within this particular zone. So now the idea is, how do we make an assessment? We have understood that the trend on the longer time frame is up. We are always looking for bullish reversals. We have to combine this with the length of the pullback, which means that we can see. So I'll just erase these patterns which were used as a reference to our earlier videos. I will also remove these lines so that it is more aesthetic. It was only created to show the gaps as they formed. And now I would just draw your attention on the pivotal high and low. So while we are looking at a pivotal high and low, we have to see the low from which the high was formed. And once we have understood that, we can extend this and understand the strength of a trend. So first we can see, we will ignore the first level that is indicated here, that is 0.36. In my assessment, I only look at two numbers, which is 0.38 and 0.618. That is 38% retracement and 61% retracement. any pullback and support above the 38% retracement necessarily means for me that the trend is very strong. If it goes below the 38% to 61% retracement, then in my view the trend becomes weak. If the 61% retracement is broken, then it is almost approaching a double bottom, and therefore here my view would be range. In other words, on the daily charts, because of the extent of the pullback, even though there is a higher top that is created, this is currently ranging. But because on the weekly charts we have analyzed that the trend is bullish, we will now assess the trend to be a range with a bullish bias. And once we have identified that the trend is a range with a bullish bias, we generally want to be on the long side of that structure, and we are looking at confirmations in order to be on the long side of the structure. What we got on the 19th of April and on the 18th of April were reversal candles which are bullish in nature, and a bullish reversal candle does not mean that a range with a long bias will become a very strong range. All it implies is that any fall that has to happen will be seriously stemmed in this particular zone, the zone that I am marking now, which is the low of the candle that is on the 18th and the low of the candle which is on the 19th. That is, this region of 21,960 to 21,760 becomes a zone of incredible support for the market, and logically becomes a place where individuals would like to buy the index on the pullback. Currently, the momentum on the market is on the upside. The general structure of the market is on the upside. Anyone would be intending to buy breaks of a market which has been pulling back. A lot of people would have been triggered long. The question is, where would they evaluate their decisions of going long? When the cup and handle pattern was formed, that point was 22,250. Now with the change in the price action and the developments as we are seeing, this is going to happen below 21,750. In other words, anyone who intends to go long on the market will typically have a stop loss of around 21,500 to 21,750, which is roughly 500 to 700 points on the index, which contributes to roughly which constitutes approximately 2.5% on the index, and roughly 7 to 7.5% on stocks, which means most traders who are trend traders, who are trading in the direction of the weekly charts, would be trading in the long side, but they will be defending their long positions till 21,750 Nifty, which is approximately 2.5% from the current value. And if they have picked up stocks, then since stocks have a 2 to 3 times beta, they would have a 5 to 7.5% or even a 10% SL, depending on the stocks which have been created since 18th and 19th of April. Now, as the price action unfolds, we will see more and more candlestick patterns form. Candlestick patterns forming at critical supports and critical resistances become far more significant, which means that this bearish counterattack, this bearish harami, these bullish piercing candles are far more significant than the doji candle that was formed on the 22nd, because this is not a pivotal high or a low, and therefore this doji need not be looked into very strongly. Similarly, the red candle that is being formed at the moment is only forming at a gap resistance, and at a gap resistance it is expected that the market should slow down, and it has slowed down, but it is not a call to sell. The trend has not reversed, and the market even on the daily time frame is trading as a range with a long bias. So one has to be very careful before going all out shorting the markets, and generally needs to look at individual stock sector specific dips in order to take up a long. For example, someone could consider maybe pharma and defend it with approximately 5 to 7.5% SL on the specific stock as we have discussed in this video. So once again, the idea of this video was to simply share the patterns as they form, and there are obviously infinite securities and potentially infinite patterns, but the general word of advice would be that for your day-to-day analysis, gaps and candlesticks are one of the most effective tools for analysis, whereas when you take a holistic view, it is then that you need to start looking at things like trend structure, extent of pullback, etc. over a period of time you would have almost memorized the chart as to what are the critical points on longer time frames, and therefore your analysis actually reduces to what is happening on the smaller time frames. And this is where the real scale of trading comes, and this is where all that we learn and we practice, we get to put it together. So I hope this video has added some depth to your knowledge. Do leave behind any questions or comments you might have. I will continue to try to answer them in the future. Thank you very much. Have a good day.